welcome to this special broadcast right here on BloombergQuint. Today I'm in conversation with this very special guest to talk us through what is the view at Nomura with regards to the current situation on ground and the market care that we have been witnessing on the back of the coronavirus pandemic. I'm joined by Saion Mukherjee. He's the Managing Director and Head of Equity Research at India, Nomura, who's joining me right now. Saion, thanks very much for taking out the time. These are unprecedented times for us, and no one has been really able to gauge this kind of damage that would have happened versus any previous calamity that was witnessed that had a market reaction. What's your take right now on the severity and the unprecedented moves that have been taken across the board from the government, from the central banks, to make sure that they are able to cushion the blow in whatever shape and form they can?
Yeah, thank you, Ravina, for having me in this show. As you said, it's pretty unprecedented times, not expected in normal course. So the damage in the stock prices have been quite severe. I think a lot can be explained by relentless FII selling, which again is unprecedented, right? Till 25th of March, the past 22 days, we have seen selling every single day. $9.6 billion worth of selling, which in absolute terms and also in terms of market cap is the highest ever, surpassing the fall or the selling that we had seen during the global financial crisis. And then, of course, now you have a lockdown, which again is quite unprecedented. During the period of lockdown, just I think 30 to 40% of the economic activity takes place, and our economics team have cut their economic growth estimate to minus 0.5% for calendar 2020, with almost a 6% decline expected in the second quarter of the calendar year. So these are the kind of numbers we haven't seen in the past. So these are surely the unprecedented times. I guess, the market is essentially, there are two parts to it, I think. One, of course, is uncertainty around the spread of COVID and what would be the end game here. I think there is a lot of uncertainty. So it's very difficult to kind of look at fundamentals at this point, because I think the most important or the most dominating factor would be the sentiment around COVID. We need to get a handle on where this thing would settle. And beyond that, I think we would get to a stage where we can look at fundamental, make a proper assessment of the damages and what impact the monetary and fiscal policy, which again, as you mentioned, has been quite unprecedented, globally, and even in India, especially the monetary policy, which was unveiled last week, was a quite comprehensive and a significant one. But given where we are, I think it's difficult for these policies to work immediately. But first, we need to get a handle on COVID, and from there on, I think these stimulus packages will start to have an impact both on the fundamentals as well as on the stock price going forward.
Obviously, there are some green shoots, Saion, globally as well, with Italy recording the slowest pace of new cases in some time, and then you have Europe, which could start to peak out. Johnson & Johnson saying they have identified a key ingredient for a vaccine, which they'll start testing in September. But keeping all this in mind, it's again going to be a time-bound event, Saion. So back-of-end calculations suggest what? It will take at least 2 more quarters before we start to see even the possibility of it.
I think that's very difficult, right? I think, for us to gauge how this particular event will play out, because we know so little. It's a novel virus. And, I'm sure a lot of people are kind of working on this. I guess there are some positives and green shoots, which you mentioned, right? I think the number of cases coming out of Europe and hopefully even in the weeks to come in the U.S. And also in India, if you see, the lockdown came in quite early, and, the rate of the cases are rising on a smaller base, but it seems that the momentum is lower than what we had seen in other countries. and then of course there is a antiviral drug which I think Gilead is trying. We may get the results end of April. You talked about a vaccine. I think a lot of these developments can get expedited. But then on the other hand, as I said, we don't know the virus well. Can there be a second wave when the lockdowns are removed across the world and people come out? Will that lead to a second leg when the winter sets in? Will there be another wave? Also, whether the virus can mutate. I think these are very fundamental questions which we don't have an answer to. So I think to say that in next 1 quarter or 2 quarters we would be completely out of it, I think would be a very optimistic assumption to make. I think some of these things, things will probably improve a lot from where we are, but the lingering effect of this episode may last for longer, going forward.
So in the backdrop of that, we've already seen a lot of pressure points across industries, and we're having industry-wide conversations now. So you are seeing the power demand coming off significantly, and therefore power plants running at just about 55%, the plant loads. You've got the insurance companies coming in and saying that the APE is going to see a dent, a new business is going to come off. You've got auto companies shutting manufacturing, plants production is coming off at a time when they're already saddled with the burden of the BS4 models which they're stuck with. So all of this put together, industry-wide, Saion, if you have to make an assessment of the worst hit at this point, what would those be?
Yeah, so again, given the lockdown situation and economic activity, coming to a standstill, so there are so many sectors, large and small, where there are just nothing happening at this point. And businesses are not meant to kind of handle this kind of situation where you do not have any revenues or very little revenues for a month or so, right? So clearly, I think, except for a few essential industries, maybe certain consumer goods or pharmaceuticals, where I think the operations would continue and the stress would be relatively lower. I think all industries will go through this stress. I think companies which are not leveraged or the fixed cost as a percentage of their revenues are relatively lower would be able to manage it well, or at least can see this time go by. But again, it all depends on how long are we going to be in this state. Now, if we start to see operations coming back in a month's time or maybe a couple of weeks' time, I think it could be manageable, and we may not see stress escalating or major dislocation getting created in the industries. However, if it gets extended for whatever reason, I think each week would build a lot of stress. So I think what's important is to see that we kind of get back to some kind of operation at the earliest, so that the cash flow mismatches that all these businesses will face is minimized. The time for which they face this mismatch is minimized. So I think definitely it is going to be that's the reason, like for instance, our economics team is forecasting a 6% decline in GDP in the second quarter of this calendar year. That itself tells you across industries that, we will see the stress.
Saion, the financials were the darling of the investor community, the foreign investor community, especially the larger names. And now that's the space that's witnessing the biggest backlash. Currently, you've seen big bankers come out and try to justify the kind of exposures that they have. But do you feel that, this has been taken a bit too far in terms of the selling?
See, financials, of course, from a stock market perspective, was something which did quite well. The ownerships were high. And, some of these bigger companies were actually growing, rapidly despite sluggish economic growth, because they were able to take market share and record good growth. So, and the market valuations had also, gone up quite significantly. So when you see this kind of change in economic outlook, obviously the financials are the ones which take the hit the most, right? And that is what is probably getting reflected in the stock prices today. So both your assumptions in terms of your, let's say, the credit growth, and also your assumptions are on asset quality are going to get challenged quite a lot. I think, though the consensus might not have factored this in, but I think the stock prices have already started to factor this because of the correction that we have seen. So there is going to be a reset, on expectations of growth as well as of valuations. And I think we aren't going to get back to the kind of expectations the street had before this particular episode. So I think, but in pockets, I do see a significant correction, which from a longer term perspective, I think makes sense to look at. So we are selectively positive on the financials, taking advantage of the fall in the stock prices. Of course, we are banking, those banks where we see they would get past this issue. They don't have a liability side issue, which some of the banks seems to be having. So the going is going to get tough for them, but given the correction in stock prices and valuations, I think it makes to selectively look at some of the financials at this point.
So what you're saying is, do you feel that at that point, it was a bit overstretched in terms of ownership, and now the pricing and the valuations seem to be matched perfectly, or they're a bit undervalued according to you?
See, I feel, if I take a longer term view, right, where, of course, we get past the COVID-19 situation and growth comes back to a normal state with less number of players, where, some of the weaker banks or intermediaries kind of move out of the business or kind of are a lot weaker. In that situation, if we take that assumption, maybe 1 year, 2 year down the line, in that context, the valuations are definitely attractive. Having said that, it's very difficult to take a call on the very near term. As I said, I think, fundamentals may not work as strongly in the near term, because I think it's kind of driven by what the sentiment is around what's happening with coronavirus. So not considering the near-term issues and challenges that each of these stocks could face, we think one should engage as and when one gets an opportunity, taking a slightly longer-term view.
Do you feel, Saion, then while looking at financials, the policies and the measures that have been taken by both RBI and the government as well will start to reap benefits in the near term? And they're good enough to support the economy at this point?
See, I think the fiscal policy, right, where we had a package which is largely supporting individuals and poorer sections of the society, I think that's what any government would do, right? The quantum of the package is not necessarily very large. We are talking about less than a percentage of GDP. I mean, it's a positive one, but can it substantially change the directions? The answer is no. Now, coming to the monetary policy, I think there were a lot of measures in terms of rate cut, in terms of liquidity efforts to ensure transmission, and of course, moratorium provided for interest and principal payment for 3 months. I think all these is definitely positive in terms of bringing stability to the financial markets, kind of avoiding any major dislocations. To that extent, it is positive. But the fact is, as you know, Devina, that we have been having a very supportive monetary policy for a long time. The liquidity has been abundant. There has been fair amount of rate cut in the last calendar year, but that has not led to an economic growth because the credit flow isn't happening through the system. So there is structural problem on the demand side, and there are structural problems with the financial intermediaries. Unfortunately, this episode of COVID-19 further aggravates the situation. So we don't expect the demand to come back, even if, let's say, the lockdown gets recovered, because there's a significant impact on people's earnings. So their ability and propensity to spend is not likely to come back. Similarly, the issues that the financial system is facing is getting aggravated. So therefore, I do acknowledge and appreciate the fact that it kind of provides stability, but at this point, I don't see it to be a big big factor in driving growth. Having said that, I feel what can potentially happen, and we have to wait and see how this plays out, is, let's say, going down the line, if the sentiment around COVID-19 improves, right? Let's say people get a treatment or a vaccine, and people are not as worried about COVID-19 as they are today, and the sentiment improves. Given the monetary push that we have seen in India and globally, that could be positive for growth and stock prices going forward. But, we have to wait and see whether that plays out. But given the sentiment at this point, it's good for stability, but not necessarily enough to, make a big impetus on growth.
Saion, at Nomura, have you factored in any EPS changes for the end of the year and probably even for next year? We had come down at the start of the year, probably mid-2019, from an EPS growth of about 20 to 23 to 18, then to 12, 10. Would that go in single digits now? Or maybe even zero growth?
Yeah. No, see, I think, the outlook is changing quite rapidly, I would say. So frankly, I must admit it is a work in progress. So when we looked at 12 or maybe, around last week, when around 14, 15 days back, when we looked at the numbers, where the consensus was, and this was before the lockdown happened, where the consensus was, we felt that there is definitely a risk of around 10%. So consensus was building approximately 22-23% earnings growth for fiscal 21. At that point, we thought it is definitely going to be lower at maybe low teens. With the lockdown now, I think there is a lot of downside risk to at least the fiscal 21 earnings. And it's quite likely, I won't be surprised if you don't see any growth or even some kind of a marginal decline, given the lockdown that has happened and the lingering effect of the lockdown, which I think would last for at least a few quarters. How FY22 plays out is very difficult at this point. We aren't really going with an assumption of any major changes. Of course, there would be the lingering effect that would continue into FY22, but hopefully, FY22, by then things would be a lot better. But as far as FY21 is concerned, I think expecting any meaningful earnings growth is out of the window at this point.
Okay. Sam, then, if at all, you would probably have any kind of index levels targets that you've put out, or that's something that you're not looking at right now?
No, I think it's, difficult to kind of talk about the index levels, particularly in the shorter term, Devin. I think what we are really focusing on is how to kind of, build the portfolios, because it's a very bottom-up approach, looking at sectors and stocks selectively rather than thinking on a top-down view at this point. Maybe at a later date when the situation gets more normal, it would be more appropriate to look from a top-down perspective.
So, Sam, let me ask you this. The leaders of the last rally, when we made our record highs, do you feel that they will still be leaders when the correction turns on its head?
Yeah, no, I think, financials, obviously, maybe you could have a different set of companies who may be in a position to lead within financials. I do see financials participating selectively. Now, some of the changes around, let's say, growth and credit quality, particularly on, let's say, unsecured lending or retail, where people were not so cautious or more aggressive, I think those things can get a reset. So you may have a different set of leaders this time around within financials, but I do expect pockets of financials where the companies really come out stronger of this episode, to be an important driver of rally. And other than that, you also had areas like consumers, which hasn't really corrected much. So difficult for them to participate as and when the rally comes. There could be other sectors which we like, for instance, oil and gas or pharmaceuticals, where we see outperformance, let's say over the next 1 year when this situation improves.
Okay. Last few questions, Saion. One on the back of, we spoke about the foreign investors in the beginning, but at a time when your own house is on fire, you really don't look outwards. So from that perspective, for a foreign institutional investor, now the focus shifts to the mother market. Do you feel that therefore in emerging markets, and especially India, should probably forget about seeing any meaningful flows till you actually see some growth that you can put on the table as proof?
Yeah, no, I think at this point, as we see the situation today, I think what you're saying is right? I mean, it becomes very difficult to be bullish on flows given the kind of outflows and the quantum of outflows that we had seen just like till last week, right? But having said that, like if you think about the fact that, there is going to be a lot of monetary push and liquidity available. And if situation improves, given the fact that there are certain things which are positive for India, for instance, the fall in oil prices, right, which is a macro positive for India. I think if the growth doesn't falter materially, I mean, I know this year is a difficult year, but just looking forward to, let's say, calendar year 21, and if we see resilience there, if we see growth coming back, I won't be surprised if India starts to get its share of foreign inflows. I won't kind of rule it out if I take a slightly longer term view. The fact is lower oil prices and whatever, disruptions which are likely to happen in supply chain can benefit India, right? For instance, we are looking at manufacturing coming to India. That's what we thought would be one of the drivers of growth for India, which I think is stalled at this point. But all this thing can come back from a longer term perspective. So yes, near term expectations are lower, but things can change, let's say 6 months or 12 months down the line when, the situation improves.
And then will India be one of the best markets that you could find if things get into place? Just one final question. How was India placed once we get the resolution?
Yeah, I mean, see, at this point, obviously, from a regional perspective, our regional strategist is neutral on India. He is more overweight on North Asia, like Korea and China. But I guess given the correction in the markets, right, it has come to a zone where, the valuations have become very attractive. See, what has happened is at the margin, there were some issues in India. Those got aggravated because of this COVID situation. So I think at this point we have a neutralish view. But if the impact of this COVID is not deep enough and we are able to come out of it, I think on a relative basis, given the correction in valuation, it may start making sense for India sometime down the line. But at this point, from a regional perspective, we like other markets more than India.
Got that. Saion, it was a real pleasure, getting your thoughts on the platform. Thank you so much for joining us this afternoon.
Thank you, Devina. Bye.
According to a recent report, women today contribute nearly 74% of real estate buying decisions. This includes 32% of single women